All right. Morning, everyone. Um, Welcome back to our morning cuppa at 8. I'm Joseph here. So, looking at the Hang Seng Index, market reacted negatively right after the Xi Jinping Trump concluded his state visits in China. Right, can see a very strong selling pressure happen in the Hong Kong market. Meanwhile, can look at the U.S. market. Equities index also pulled back on the Friday sessions. Looking at the meeting of these both leaders, they have actually penned out a few policies, including they are going to setting up a trade board, right, to facilitate more discussions to open up to foster more trades between the both countries. But so far, there's not much big deal was announced over the 2 days visit. Meanwhile, the over the weekend, Iran's are also eyeing to exert more influence on the subsea cable that carry the data, right? And meanwhile, we can see look at the oil price, right? Also actually went up on the Friday sessions, showing that the after the meeting between Trump and Xi Jinping, right? Now the world attentions are going back to the oil price again, and also because of the expectations of a higher oil price, higher inflations, market is actually worried about hotter inflations. And look at the this morning, right? Based on the FOMC, this tracker by the CME, can look at the coming June meeting. And right now, the Kevin Walsh has become the president, chairman of the FOMC, right? So it's going to chair the first Fed meeting on the June, right? Market is pricing uh, anonymous vote that there's no rate cut on the coming June. Meanwhile, on the year end, right, we can see that it's a very only 0.5% there will be one rate cut this year. Meanwhile, 50% thinks that there will be rates will be maintained here at 3.75. Then on, there's now a small group of about 48% thinks that there will be one or two rate hike by the end of this year. These are because of the expectations on the higher oil price, higher inflations. That's what the market is actually looking at right now. Now, what is the implications of these interest rate moving up? So once the interest rates are moving up, the valuations on the tech stocks will be actually coming down. So as a higher interest rate, right, the discount factor will be a higher, and then on market will have to reassess on the valuations on the growth stocks, particular on the tech companies. So at the Hong Kong market, what we do see is that on a weekly basis, most of the stock have a pullback, apart from the uh, JD.com. They have announced a better than expected results. We also see the 2015 EV car counters have went up by 10%, and media also went up by 7% over the week. So this morning we'll be looking at two trading stock in the Hong Kong market. Firstly, the Vitasoy International 345 break past 6 Hong Kong dollar 50 cents. Now, next R1 will be 6 Hong Kong dollar 80 cent, and followed by the $6 mark. Downside support is $6.25. Then on we have the media group, stock code 300, break past 90 Hong Kong dollar on the back of high volume, eyeing to test 95, followed by 100. Downside support is 87. Now at the US market, right? Before I continue in the futures market, we have a bullish bias on the crude oil. We think the upside still remains intact. Gold, we do see a downside risk, and on the Friday, because of the expectation of higher inflations, it's not the higher inflations, a higher interest rate on the bond yield, right? And the bond yield, the real bond yield have actually picked up, right? And that have suppressed interest on the gold, and gold have seen very strong corrections last Friday. Now, so during our futures event that concluded 1 week ago, I shared with the audience one of the indicator that I use in trading gold, which is the real bond yield. That will give me the advantage in looking at the leading indicator when I'm trading the gold. Looking at the when I'm looking at gold, sorry, looking at the uh, S&P, right? Uh, index have pulled back, and right now is in a corrections mode. Despite that, the over the week, can see that the Micron, Nvidia, Apple, LITE have returned a positive return. And last week we did mention about Cisco, right? After the results announcement, it has a breakout by at least 12% on the last Friday, right? Then on, our attention will continue on the cybersecurity related counter, Palo Alto, CrowdStrike, right? And also last week we mentioned about eBay, right? Due to the takeover did not materialize, but the eBay share price continued to move upwards. Right now it's breaching the 115 level, right? The uptrend trajectories remain intact on eBay, right? Then on the market, apart from the memory counters, market also looking at the cybersecurity team, right? CrowdStrike is going to have their results announcement by the early June. We still have about 2 weeks before the QR. Then I'll be looking at Sentinel One. They are going to release their results next week, just before June, right? And at this juncture, right, the cybersecurity related counters have seen the share price on a high trend, right? Apart from the net, right? Cloudflare after results, share price have came down. Um, Hence, coming before the announcement made on the Sentinel One, on the technical basis, I do see that Sentinel One share price right now is showing a bullish setup, breaking past 1650, and next resistance will be 18, followed by 20. Downside support is 15, right? Secondly, since the tech stock may have a selling pressure, right? Market is going into rotates into a different sector, which is the oil, right? Since the crude oil have been moving back above 100 level again, right? The ExxonMobil have break past 115, eyeing to test 165 and followed by 175. Downside support is 145. Now, based on Malaysia index, 1750 has become an immediate resistance coming this week before we end the May, right? They may have a corrections, and I just want to reiterate that May do have a chance to see an index pullback since the uh, one of the old saying was sell in May, but we should not go away. We should reposition because a better month ahead will be June and July. Usually, July will be one of the more bullish month. On the downside, the FBM TLCI will be support at 1645. Right, on a weekly basis, tech stocks continue to lead the pack, went up by 2.8%, followed by industrial 2.72. Utilities and plantation have faced a strong profit taking last week. Right, FKLI we still keep bullish bias, and FCPO last week have breached our stop loss point. The corrections was deep, and negative momentum is strong. Now we have a bearish bias on the FCPO. We think there will be a chance to see a retracement towards 4003 followed by 4002. On the upside, we set our stop loss point at 4007. As for some of the interesting tech stocks, we see that Northeast have a very strong selling pressure. So let's see whether these corrections is it going to pull back towards 84 to 80, right? I think the 80 level will be a very strong support for Northeast. Then on Wentel also have a mild corrections last Friday. Right, I think the downside support will be between 27 cent and a half, and also 24 cent and a half. This is the support level that I'll be looking at Wentel in this May, right? Waiting for their quarter results. And Looking at the trading stocks, firstly we have TMK Chemical, one of the jewel stocks that we have published last week. TMK have a break past 1 ringgit and 75 cents on the back of high volume. It's going to challenge 1 ringgit 85 and followed by 1 ringgit 95. Downside support is 1 ringgit and 65 cents. Then on we have MN Holdings, breaking past 2 ringgit 30 cents, eyeing to test 2 ringgit 45 followed by 2 ringgit 60. Downside support is 2 ringgit and 15. So we have two breakout stock Malaysia market this morning. Firstly, TMK Chemical, followed by MN Holdings. So I stop here and pass on to Sian on the Rasa Mingguan report. Thank you.
Thanks, Russell. So good morning, everyone. Please let me to share my screen. Okay. So as what we actually highlighted in our last week Rasa as per Friday. So we do see that currently as indicated by our RHB risk sentiment index, it's moved to lower to a risk neutral zone against the record rally of the US equities, a sign that equity valuations have moved uncomfortably higher in the absence of a strong fundamental drivers as well. So we do advocate a short-term sell in risk assets for now and a move towards a defensive assets. So two conflicting signals was being observed. So firstly, the RHB risk sentiment index, which theoretically leads the S&P index by 2 weeks, has trended lower towards the risk neutral zone against the S&P, so which had rallied to a new records in the previous weeks as well. So second, we see a very strong equity inflows into the developed market space, led by AI-related tickers such as Nasdaq and Kospi, but the emerging market equity flows turn into net outflows, led primarily by China as well. So as what we see from the RHB risk sentiment index, so basically there's a divergence between the RHB risk sentiment index, our in-house risk sentiment index, and also the S&P 500. So we have now returned relatively cautious on the AI-related rally as well. So and then moving on, so we also seeing that key economies has seen a higher producer prices into April as well, which is also an early proxy for higher CPI into second half this year. We are already seeing that there's a higher PPI prints for selected major economies, including China, US, and also Japan. So similarly, on the global front, consumer inflation is actually heating up into March and April as well for Europe and also United States, and for ASEAN. So Philippines is also seeing a higher inflation at 7.2% in April, which is also the highest since March 2023, where Thailand has also started to exceed the deflation, and Singapore is likely to see an inflation rate of more than 4% in April as well. So due to still elevated oil price as well we're seeing now. So on Malaysia, we are also seeing the release of final print of GDP for the first quarter in last Friday. So where it also more stronger than expected, printed at 5.4% compared to first quarter advanced estimate at 5.3%. So the final estimates of the GDP take into consideration the data for March as well. And the print of 5.4% is also exceeding our in-house projection of 5.2% and Bloomberg consensus estimates of 5.3%. So due to stronger than expected growth in exports and also manufacturing sector, so for the first quarter. So for now, for the full year, we still maintain our 2026 GDP projection at 4.7% with a modest upside bias towards 5%. So due to firstly, stronger than expected first quarter GDP print, so while our composite leading indicator, which is the RHB Malaysia Leading Index, continue to signal a sustained growth momentum into second quarter in this year as well. So despite a heightened geopolitical risk premiums, our auto-regression model and leading index assessment continue to point to second quarter GDP growth at a growth range of 4.7% to 5.3%. So suggests a sustained growth momentum into the coming quarter. A strong second quarter growth clip, if materialized, might suggest an upside bias towards 5% growth for this year. However, we still remain alert to the evolvement of the geopolitical tensions and the impact of the elevated oil prices. We think that the spillover impact on Malaysia economy due to the elevated oil prices and the geopolitical tension will depend on the persistence and severity of the conflict, as well as the potential mitigating measures. So under a silver stress scenario involving renewed geopolitical escalation and damage to energy infrastructure, with the oil prices potentially surge to $140 per barrel, Malaysia GDP growth could still potentially score towards 4% growth for this year in the worst case scenario. So meanwhile, for the first quarter at this juncture, we're still seeing that across the sectors, there's a broad-based expansion. So except the mining sector, in fact, the growth in services and manufacturing sector has been stronger than expected. So similarly, we have also seen the release of the current account balance of payment data for the first quarter, where the current account in the first quarter registered a higher surplus at 3% of GDP, so versus fourth quarter print of 0.5% of GDP. So due to higher goods and services account surplus. So that's all from now. That's all from me for today. I'll pass the stage to the next presenter. Thank you.
Hi, thank you, Sian. Let me continue with result review now on Westport first quarter result. The result came in within our and the street expectation. First quarter core PATAMI up 53% year-on-year to 340 million ringgit, which is also up 20% Q-on-Q, tracking about 30% of our and the street full year estimates. This is mainly driven by a higher tariff. Within the results within expectation, because first quarter result only reflected about 1 month impact from the higher fuel cost, with the full impact is expected by second quarter onwards. And now talk about the volume. First quarter volume down 1% year-on-year to 2.7 million TEUs, which is about 23% of our full year estimate. The retracement was mainly driven by a weaker gateway volumes, dragged by the congestion issue back in early of January. However, management has confirmed that the total container volume up 3% year-on-year in April, following the resolution of the congestion issues. And the average yard occupancy rate is recorded at 81% in the first quarter, as compared to 72% last year. And looking ahead, we believe our earnings forecast is achievable, as we have already factored in a 30% higher fuel cost due to the Middle East conflict. First quarter results, we saw a 17% increase in the fuel cost, and now it make up about 19% of the total OPEX in the first quarter. And we do not foresee the fuel cost to surpass 23%, which is the highest level back in 2022 due to the Russia-Ukraine war. In addition, the fuel consumption is expected to ease by about 10% in the fourth quarter, following the deployment of 60 EV trucks by third quarter. Meanwhile, Westport is exempted from the AFA mechanism, barring any rising electricity costs due to the Middle East conflict. And the congestion issue observed in the early of January have been fully resolved, with the yard density rate now maintained at a healthy level of 70%. As a result, we maintain our volume growth forecast of 4.5%, within management unchanged guidance of a low single-digit growth. All in, we maintain our earnings and target price given the enlarged result, and we recommend investors to accumulate on weakness, as we believe the conflict risks have largely been priced in. Westport is now trading at 16 times PE, and we continue to see upside potential to the government to establish a fuel cost pass-through mechanism, but the timeline remains unclear for now. Let me stop here and pass the floor to the next speaker. Thank you.
Okay, thanks, John. Morning, everyone. Let me continue with results review on Carlsberg. This is their first quarter results. Essentially, the results were within expectation, meeting 25 to 26% of our and consensus forecast. If we look at numbers, our first quarter sales was up 7% to 706 million. This is mainly underpinned by the solid 10% jump in Malaysia, thanks to the longer Chinese New Year selling period in 2026, as Chinese New Year was a bit later this year as compared to 2025. Meanwhile, Singapore saw a 3% sales decline. That's mainly due to the strengthening of ringgit against Sing dollar. In Sing dollar, same currency comparison, the sales in Singapore was actually up by 3%. Sri Lanka-wise, it also saw a surge in associate profit by 23%. So Altogether, group net profit grew 5% to 99 million, with net margin remaining stable at 14%. Dividend-wise, 24 cents was declared for first quarter 26. This is slightly higher than the 23 cents declared for the same period last year. Going forward, I think that there could be some implications to input costs coming from the Middle East war, as we believe a bulk of the raw materials are imported. That said, Carlsberg's scale of operation and diversified supply sources should mitigate some of the impact. And while we expect overall consumer sentiment to be dampened by the ongoing political tensions, we expect Carlsberg to counter it by getting more aggressive with their marketing initiative or strategies to stimulate consumer spending. In addition, rising tourist arrival, given that it's Visit Malaysia year this year, and the full impact of price increases implemented end of last year or towards the third to fourth quarter of last year, should provide further support to FY26 earnings. Post results, we make no changes to our earnings forecast and target price of 20 ringgit 80 cents based on a 16 times forward PE. We continue to like the brewery sector for the relatively resilient demand and stable profit margins, which facilitates a generous dividend payout. Dividend yield is close to 7% at this price. So all in, maintained by target price is unchanged at 20 ringgit 80 cents. Thank you so much. Let me stop here and pass on to the next speaker.
All right, thank you, Siang. We have a MGB results review for first quarter 2026, where MGB recorded a core profit of 14 million ringgit, which was 15% year-on-year higher and met 26 and 27% of hours and street estimates, which we deem to be, broadly in line. And much of the strength came from the construction segment, which saw its PBT double to 13 million from 6 million ringgit from the year ago, thanks to the smaller losses from the overseas subsidiary, along with some projects that attained vacant possession status ahead of time, which led to some cost optimization. Meanwhile, the property arm, saw a 22% year-on-year drop in terms of PBT due to most of projects reaching completion with minimal progress, and also at the same time their upcoming property projects are only slated for 2027 onwards. So all in, we think that of course first quarter 2026 the impact was only seen for March alone, but moving forward we think the pressure from higher material costs should be manageable, as MGB does have a good relationship with its cement suppliers, which could mean that they could get favorable rebates. But I think all in, we continue to like MGB, given that due to its smooth execution of projects. Bear in mind, I think it was still profitable during the COVID times, compared to other contractors which faced headwinds during that time. So all in, we make no changes to our earnings estimates, but roll forward our valuation base year from 2026 to 2027. Therefore, we derive a new SOP derived TP of 63 cents from 60 cents. Rating catalyst would be if it's industrial projects like the Kerteh Biopolymer Park could take off earlier than expected. Yeah, so that's about it, everyone. Thank you for dialing in for today's RHB Morning Kappa at 8. We will see you tomorrow at the same time and same place. Have a great day ahead. Bye-bye.